Danger, danger, double caution, triple caution, oh God. Hide your wife, sell your kids, let your dog go free. You can't support them anymore. This is it, it's all over. The yield curve, it inverted. Which I think is bad, right? At least that's what my newsfeed keeps saying with all these headlines of a recession. But then again, when is the media not telling me that the sky is falling? Because that's their job, just stress me out so I click on their article. But not Real Vision though, so subscribe. The problem is that none of these media outlets actually explain why an inverted yield curve leads to a recession. I could not find a good explanation anywhere. So, as usual, I gotta explain it myself. Today I'm gonna tell you how the yield curve works, how to use it, and what it's actually signaling about the economy and the market. And it's all going down on this week's episode of Real Vision's The One Thing. What's going on, investors? AK here. Now, the yield curve is basically just a line that plots the yields of US Treasury bonds with different maturity dates. The curve lets you easily compare rates on short-term bonds versus long-term bonds. And on this chart next to me, you could see that long-term bonds are yielding more than short-term bonds. The line is going up from left to right. And when that's the case, it's called a normal yield curve. We'll talk about flat and inverted yield curves in a second, but what you need to understand about a normal yield curve is that it signals that the economy is going in the right direction. Let me explain why. So like we talked about in our last episode, short-term yields are mainly influenced by the Federal Reserve. When the Fed wants the economy to expand, they keep rates low. But if they want to put the brakes on an overheating economy, then that's when they raise rates. Now, on the other end of the curve, long-term rates are mainly influenced by investors' expectations. If investors think the economy is in good shape, then instead of bonds, they're going to invest in riskier assets like stocks. That'll keep bond prices low, which means long-term rates will be higher. Plus, when the economy is strong, inflation usually rises. And rising inflation means that you need a greater return on your bonds because otherwise you're basically losing money by holding them. And that's another reason why long-term bond yields rise when investors' expectations are good. Remember, the price of a bond and its yield are inversely related. So if bond prices go up, then yields are going to stay low. And if bond prices go low, then yields are going to be higher. When investors see danger ahead and they get scared, that's when they pile into those same long-term bonds for safety. That raises the price of those bonds and lowers their yield. So all in all, when the economy is good, the Fed is going to keep short-term rates low and investors' expectations are going to keep the long-term rates high. And that's why you're going to see a normal yield curve as a result. Okay, now on to flat or inverted yield curves. So when you start to see a yield curve flatten or even invert, meaning that short-term rates are equal to or even greater than long-term rates, then that's what usually signals trouble ahead in terms of recession and lower market prices. Two things need to happen for a yield curve to become like this. First, the Fed has to raise short-term rates because maybe according to their mandates, they see an economy overheating and they want to raise those rates to cool it down. Higher rates hurt economic expansions. Second, investors' expectations for the future become negative, so they start piling into those long-term bonds for safety, which lowers those yields. Those two working together give you either a flat or inverted yield curve where short-term rates are equal to or greater than long-term rates. And like I said before, that signals trouble ahead. You can see how this works in this chart comparing the yield curve to the S&P. In 2000, before the Y2K bubble popped, the yield curve was inverted. In the following recovery, the yield curve went back to normal until the housing bubble where the curve flattened again. Then once again in the recovery, it went back to a normal yield curve. And now today we're seeing the yield curve flatten and invert again, which is why we're seeing headlines that the recession is around the corner. But just because the curve is inverting now doesn't mean that we're going to have a recession and a market crash tomorrow. As Dr. Kamal Srikumar, president of Srikumar Global Strategies, explains in this Real Vision interview, the timing is a little more tricky than that.
In terms of where we are headed, if indeed my forecast recession comes about, you are looking for the bond market to be a good leading indicator. That means the 10-year yield drops, the 2-year does not fall as much, and so you have an inversion of the 2 to 10. And that expectation leads to a recession, let's say end of 2019, beginning of 2020. And based on past experience, Brian, when that happens, 3 or 4 months later, the yield curve again starts to steepen. The bond market has done its job, and now it's going to look for an economic recovery sometime in late 2020 or the beginning of 2021. So the bond yield goes up. On the other hand, the equities market have not been as good a predictor. They were a lousy predictor of the Grand Recession in 2007 to 2009. Bond market, the yield curve went negative in November 2006, exactly 1 year before the Great Recession began, whereas the equities were merrily marching upward into the first half of 2008. That is what I expect to be repeated. Equities probably go up for a bit when the bond market is suggesting a recession, and then eventually the equities take a dive, and the bond market also, you have a loss, meaning the yields start to move up. And that's a sequence I see for the next several months.
And you could trust what he says because he's a Kumar, just like me. That's what the K in AK stands for. So you know he's smart. Or maybe you know I'm smart because he's smart. I don't know, we're probably related somehow. So yeah, analyzing the yield curve is important, but it should just be one of many things you look at to determine the health of the market. And if you want help with that, then make sure you subscribe to Real Vision. I'll see you next week.